If you want to supercharge an economy, the conventional playbook says you just need to slash the value of your currency. Cut the price tag, and suddenly your country's factories are working overtime. The logic seems bulletproof. A weaker dollar or lira means your goods are suddenly on clearance for the rest of the world. Foreign buyers swoop in, orders pile up, and money flows back home. But that rush of international cash rarely trickles down the way people expect. We have to look at what is happening to the people actually living and working inside that newly competitive economy. When a government actively drives down the value of its own money, it imposes a quiet, aggressive tax on everyone holding that cash. By marking down the cost of everything a nation exports, you systematically drain the purchasing power of the people producing it. Think of an exchange rate as the conversion factor between your paycheck and the rest of the world. When your currency drops, your entire country goes on a massive clearance sale. This diagram illustrates the upside. As the home currency loses value, foreign buyers get more for their money, so export sales shoot up. But momentum swings back. Because your money is worth less globally, imported goods immediately cost more, and no country produces everything it needs. The price of oil, computer chips for electronics, and basic agricultural staples shoot upward practically overnight. The seesaw forces an unavoidable trade-off. To give international buyers that attractive discount, everyday citizens end up paying a steep premium for their daily survival. You might think the exporters themselves are immune to this dynamic. They are making more sales, so they should be thriving. But modern manufacturing relies heavily on global connections. Building a car or assembling a smartphone requires raw materials, energy, and specialized parts from all over the world. Inside the factory, inflated baseline costs for imported materials aggressively squeeze the final profit margin, consuming the extra revenue from the export boom. Furthermore, paying back loans denominated in stronger currencies becomes a suffocating, heavy anchor. An economy wired into the global market cannot simply cheapen its currency to generate wealth. The math breaks down when you rely on outside components to function. We saw exactly how this plays out in Turkey during late 2018, when the lira shed nearly 40% of its value. This chart tracks the currency's fall alongside trade volumes. Just as economic theory suggests, Turkish exports climbed steadily, jumping over 10% in the fourth quarter. Yet the secondary shockwave arrived immediately. The cost to import energy, raw materials, and consumer goods into Turkey multiplied rapidly. That import squeeze forced businesses to raise prices across the board, pushing national inflation up to roughly 25% by the end of the year. For the people earning their wages in lira, the math was devastating. Their paychecks stayed the same, while the cost of rent, groceries, and fuel skyrocketed out of reach. Despite breaking records for export volume, the broader Turkish economy contracted, proving that cheapening the currency triggered intense financial pain for the public. So when a currency is slashed, who is actually picking up the tab for the sudden export boom? In the short term, the winners are clear. Select exporting corporations clear their inventory, and foreign buyers secure a steep discount on global goods. This balance scale shows the reality for everyone else. Everyday consumers and domestic businesses reliant on foreign materials are crushed by the weight of surging inflation and severe import costs. Fiddling with exchange rates to manually suppress prices is an illusion. It serves as a flawed, temporary substitute for actually building long-term, structural economic productivity. A weak currency comes with a heavy price tag. Wise economic policy requires protecting the purchasing power of the entire nation, rather than sacrificing it to give foreign buyers a bargain.